Hi, this is Spencer with the Harvard Mortgage Team, and today we'll be talking about temporary rate buydowns, specifically the 2-1 buydown. So you may have heard this term thrown around, but we're going to talk today about what does it mean and how does it work and how can it benefit you as a buyer. So a 2-1 temporary rate buydown is paid for using a seller concession, and it's going to lower your interest rate 2% the first year and 1% the second year from today's start rate. And this actually just came about recently because in 2023, it shifted to more of a buyer's market. So now, as a result, sellers are giving concessions, and you can use those seller concessions to pay for things like a 2-1 buydown. So this is something that actually wasn't even possible a couple years ago, but now, as a buyer, you can take advantage of this unique time in the markets for a 2-1 buydown. So we'll say the rate today is 7%, and we'll say you're looking to purchase a home for $500,000 with 20% down, $100,000 down. So that's a loan amount of $400,000. Now, if we look at just the principal and interest payment only, your full mortgage payment's going to include taxes and home insurance as well. But the principal and interest on $400,000 loan amount at a 7% interest rate is going to be about $2,661 per month. Now, if you take advantage of a 2-1 buydown, your first year, that interest rate is going to be only 5%. So that drops your payment down to $2,147 a month for principal and interest. That's a savings of about $513 a month, which is huge. And, as a seller, if you just cut your price $10,000 on the buying end, maybe it's going to lower your payment $50 or $60 per month. But if you keep that same sales price and instead offer a $10,000 seller concession so that the buyer can use a 2-1 buydown, you can see that it's massive different in the savings, at least in the first 2 years. Because in year one, you're going to be saving about $500 a month. In year two, the rate's going to jump up to 6% now. So that would be a payment of about $23.98 per month for principal and interest, but still $263 saved per month compared to the original start rate of 7%. Now, hopefully interest rates aren't going to be this high forever. So if or when they do come down, you can still take advantage of a refinance to lower your rate and lock in a lower rate for the full 30 years without having to worry about it going up or down. And how it works is they take the buydown fund, the fees, the fund that's basically going to be used to make up that difference of the $500 a month the first year, the $200 a month the second year. It goes into an escrow account, and if you do decide to refinance maybe a year and a half in, there's still going to be a little bit of money left in that escrow account. So you can actually get that money back and use it on your closing costs for your refinance to lower your rate. So it's a pretty great thing to take advantage of right now. And you may ask, well, why would a seller do this? Why would a seller pay to lower my rate? And it's really just because it's a buyer's market now. In 2020, that wasn't a thing because you, as a seller, you put your home on the market, you get 30 offers, and you take the highest bidder. But now things have changed. You put your home on the market, maybe it sits for 30 days. Nobody makes offers. So to entice buyers, it's the other way around now. They're offering a seller concession. So it's a great way to take advantage of this unique time. If you have some properties you would like to run the numbers on, or if you want to see what you could potentially be qualified for, feel free to give us a call or send us a message. Thank you.